In this video, we're going to talk about the experience that some countries had with the gold standard and why they eventually chose to leave. So we're going to focus in this segment on Britain from 1900 to 1935. And each of these graphs you see over here show some statistic about Britain over that time period. And so on the top left here, we have the unemployment rate in Britain from 1900 to 1935, which ranges from a low of about 0% to a high of over 20%. And on the top right over here, we have the value of pounds in gold. This means that if you had one British pound, how much gold could you get in return for it? And so as this graph goes down, it means that you can get less gold in return for your pound, meaning the pound is becoming less valuable in terms of gold. On the bottom left over here, we see the interest rate that is set by the Bank of England, and this ranges from a high of about 7% to a low of 2% over here. And finally, on the bottom right, we have the wholesale price level in Britain, which ranges from a low of about 10 to a high of about 25. Now, this wholesale price level is basically a measure of the price of numerous goods and services in the economy and will give us a sense for what the inflation rate was in Britain at a particular time. Now, I'm going to add some markers to this graph to basically show you when World War I began and ended. And so the first line over here shows when World War I started in about 1914 and when it ended about 1918. And so let's first look at the period before the war. And we notice a couple of different things about this period. The first is that this line, which showing the value of pounds, of British pounds in gold, is constant. And the reason it's constant is because Britain is on the gold standard, and that by definition implies that you can exchange British pounds for a fixed amount of gold. The other thing we notice, which is not surprising, is that the price level in Britain at that time, before the war, was very stable. And as we've talked about in the previous video, this is something that the gold standard does very well, which is keep price levels stable. And finally, we also notice that the unemployment rate in Britain before the war was relatively tame, with a high of about 6 or 7% over here. Now, in 1914, World War I began, and to fund the war, the British government borrowed a whole bunch of money and then spent it on the war effort. All this spending effectively doubled the amount of money that was in circulation in the economy, which caused the price level that we can see over here to basically increase dramatically. And so we can see the price level go from about 10 over here before the war to about 20 after the war. And so over the war, because of the government spending a whole bunch of money that it had borrowed to fund the war effort, the price level in Britain doubled. The other thing the British government did the moment they declared war on Germany was that they suspended the gold standard. And if you think about it, this makes perfect sense. If the government is going to basically borrow a whole bunch of money and spend it, thereby doubling the money supply, people will have a strong incentive to basically try to exchange their currency for gold. And to prevent people from hoarding gold, the government basically suspended the ability for people to convert their British pounds to gold. And so even though the price of pounds in gold here is shown to be the same as it was before, in reality you couldn't actually exchange your British pounds for gold during this period. The other thing we notice by looking at this graph on the top left of the unemployment rate is that the unemployment rate in Britain during the war was extremely low. And this isn't particularly surprising because during a war, a lot of a country's resources and labor force is involved in the war effort. And so it's not surprising that the unemployment rate hit something very close to 0%. So by 1918, the war was over. The price levels in Britain had more than doubled. Britain was off the gold standard and unemployment had been very low. Now, it's very important to understand that at this point, the British Central Bank felt that it was extremely important that Britain eventually returned to the gold standard. And the reason they thought it's important is because they were thinking of an experience that they had had 100 years prior to World War I. During the Napoleonic War, Britain had done something very similar to what had happened or what it had done during World War I. While they had been fighting the war with Napoleon, they had doubled the money supply in their economy, thereby doubling prices. And after the war was over, they decided to return to the gold standard by increasing the interest rate so as to contract the money supply to be back at the level that it was before the war. Now, while it was extremely painful to contract the money supply because it resulted in 1 million people being put out of work, after Britain was back on the gold standard, they were rewarded by about 50 or 60 years of prosperity. And so the British Central Bank really saw this experience from the Napoleonic War and then tried to apply or try to recreate it again after World War I. And so they felt that it was imperative that Britain return to the gold standard. So now imagine that your country has effectively doubled its money supply over 4 years. So now the ratio of the amount of currency circulating in the economy to the amount of gold just increased by a factor of 2, because the amount of money increased, but the amount of gold hasn't changed. And so if you want to go back on the gold standard, what can you do? The only option is to contract your money supply. And how do you contract your money supply? The logical way to do it is to raise interest rates. And so we can see that right after World War I, the British Central Bank raised interest rates over here to 7%, which caused the unemployment rate to shoot up to about 20% over here, and which eventually started causing the price level to start declining, which we see over here. But things didn't really work out so well for Britain, and you can see the reason on this yellow graph over here. As you can see, after the central bank increases the interest rate, which causes the price level to start declining, the price level goes down, but it doesn't go down to the level that it was before the war. And this is a really big problem, because if you remember from our video previously, if a country is on the gold standard and it has a relatively high unemployment rate, the only way that it can attract new gold and thereby expand the money supply and thereby cause the unemployment rate to go down is by creating a trade imbalance. And the way you create a trade imbalance is by exporting more than you're importing. But because the price level in Britain wasn't going down to the level that it was before the war, but more importantly, that it wasn't going down relative to other countries in the world at the time, British exports were still relatively expensive compared to exports from other parts of the world. And because of that, Britain couldn't compete with the goods and services that were being produced by other countries. And because people weren't buying British goods, they weren't able to create a trade imbalance in Britain which would cause gold to flow to them. So the fact that this price level wasn't going down further was a huge problem in Britain, and is the reason that this unemployment rate in red is still elevated over this period that I've just circled. Because the price level in Britain didn't go down enough, Britain was not competitive in the world market for goods, and that caused a stubbornly high unemployment rate in the economy. Now, what was it that caused this price level to not go down? Well, if you look at this graph over here, it shows the percentage of workers in Britain that were members of trade unions. And you can see that the amount of people who were a part of a trade union increased tremendously from 1900 to about 1918. In fact, you can see the increase over there from about 10% in 1900 to almost 40% by 1915. And because so many more people were members of trade unions, it allowed workers to negotiate much better deals for themselves with their employers. So another graph I'll show you over here shows the number of work days that were lost because of labor disputes in Britain. And so as you can see, in the early 1900s, there were almost no work days that were ever lost because of labor disputes. But by 1920, it was relatively common for there to be labor disputes that would cause a loss in work days. And this made it very hard for employers to cut down on wages for their workers, which made it very hard for the British to produce goods more cheaply than other countries in the world, which made it hard for them to export goods, which made it hard for them to attract gold, which made it hard for them to increase their money supply and lower unemployment. Despite all these problems, the British thought it was a good idea to go back on the gold standard. And not only did they go back on the gold standard, but they went back on it at the same exchange rate to gold that they were at before the war, despite the fact that they were a significantly weakened economic power. To make matters worse, in 1929, the world entered a global recession, and therefore there was even less demand for British goods abroad. And so it's not surprising that the unemployment rate in Britain towards the end of the 20s skyrocketed to about 20%. To add to these problems, in 1931, there were worries that a British bank was going to go insolvent. And because of this, a lot of foreigners who had money sitting in British banks began to redeem their British pounds for gold and to move the gold outside the country. And so this began depleting the central bank's gold reserves, and they were faced with the option of either going off the gold standard or raising interest rates to try to stem the flow of gold outside of Britain. Raising interest rates even more would have caused this unemployment rate that was already at 20% to likely skyrocket to something even higher. And so it's not surprising that at the end of the day, in September 1931, Britain went off the gold standard. And so what this meant is that the British pound became much less valuable compared to gold, which we can see on this graph over here. We can see the exchange rate between pounds and gold declining, so that pounds are becoming much less valuable compared to gold. And we also see the deflation or the decreasing prices in Britain stop after they went off the gold standard. And because the British pound was now worth less, that meant that exports were now cheaper to the rest of the world. And so it's not surprising that after Britain went off the gold standard, unemployment started declining. And so the big picture here is that even though the gold standard did a very good job of containing inflation and keeping unemployment low in Britain pre-World War I, it wasn't flexible enough to allow Britain and other countries to deal with the realities of a post-World War I era. In the case of Britain, these realities meant that workers had higher expectations for what their minimum wage would be and what the maximum hours they would work would be, which made it much harder to deflate wages in your economy to make it more competitive relative to the rest of the world. These days, most economists agree that it would be a bad idea for the world and for the US to go back onto the gold standard. And hopefully after seeing these videos, you have a sense for why they think that. These days, gold does not function as the official currency in any country. And so in the next few videos, we'll try to understand why gold is perceived to have value in this day and age.